Welcome to Iron Financial. We're the place you come to forge a stronger portfolio because we cut right through the market weakness. Today, we are absolutely tearing down the latest earnings report from Tandem Diabetes Care. That's ticker TNDM. Now listen to this. They just hit a massive milestone. Over $1 billion in annual sales. I mean, that's a monumental number. But, and this is a huge but, buried right under that shiny headline is another number. One that should make any serious investor out there pump the brakes hard. We're talking about a net loss of over $200 million. So what we're looking at here isn't just an earnings report, it's a genuine paradox. And that's exactly what we're here to solve today. We're going to figure out if this company is building a fortress for the future, or if this whole thing is just a house of cards ready to collapse under its own weight. Okay, so here's our game plan. This is how we're going to crack this thing wide open. First, we're going to lay out the core contradiction that's driving the stock right now. Then, I'm going to step in and forge the bull case, really looking at the raw, undeniable power of their sales engine. And then from there, I'm going to come in and stress test that whole structure. I'll be looking for the cracks, the weak spots in the foundation that really tell the bear story. After that, we'll dissect their big strategic overhaul, what they say is their master plan to rebuild. And finally, we're going to bring it all home and deliver the Iron Financial verdict. Let's get right into it. So this, right here, is the question. This is everything. It's the one thing that separates a flashy, temporary story stock from a durable, solid, long-term investment. Hitting $1 billion in revenue, that's an incredible achievement. It absolutely screams market acceptance. It tells you they have operational scale. But when that billion-dollar engine is just burning through cash and posting a loss of this size, the market has to stop and ask a really hard question. Is this growth engine actually sustainable, or is it fundamentally broken? That's the conflict, and that's what we are here to resolve today. All right, so let's frame the battlefield here. On one side, you have the bull case. It's a story of just explosive growth, record high margins, and what looks like total market domination. It's a really powerful narrative. And then on the other side, you've got the bear case. This is a story of widening losses, cash reserves that are just shrinking by the quarter, and some very serious questions about the company's long-term financial stability. And the craziest part? Both of these stories, they come from the exact same SEC filing. Our job is to put them both under pressure, to stress test them, and see which one really holds up. Okay, let's start by building the bull case. Before we even think about talking about the problems, we have to respect the strengths. And let me tell you, Tandem's top-line performance is, without a doubt, impressive. This isn't just some lucky break. This is the result of a powerful growth engine that's firing on all cylinders. So what we're going to do is examine the core components of that engine. I'm going to show you exactly where all that power is coming from. Let's begin with the big headline number, the one everyone's talking about. For the full year 2025, Tandem cleared $1.015 billion in worldwide sales. You have to understand, breaking that billion-dollar barrier is a massive psychological and operational milestone for any company. It moves you into a completely different league. It proves you can scale production, that you can manage a global supply chain, and that you can command a serious chunk of the market. This is no longer just some startup with a good idea. This is a major player in the medical device industry, and that's a hard fact the market simply cannot ignore. Now, the efficiency story here is absolutely crucial. You have to pay attention to this. In the fourth quarter, Tandem posted a record 58% gross margin. Now, why is this metric so critical? Well, it means that for every single dollar of product they sell, 58 cents are left over to cover all their operating costs and eventually to generate profit. A high and, more importantly, an expanding gross margin like this tells you two things. First, they have strong pricing power, which means they aren't just slashing prices and running huge discounts to make sales. And second, it shows excellent operational execution. They're building their pumps very efficiently. It is a sign of a very, very healthy core business operation. Okay, but is this growth even real? Or is it just a bunch of accounting noise, something that looks good on paper but doesn't mean anything? Well, the answer to that lies in their non-GAAP sales growth, which came in at 12% for the full year. We look at non-GAAP here because it strips out all the complex accounting from a legacy upgrade program that actually ended back in 2024. What that does is it gives us a much cleaner and apples-to-apples comparison of the real underlying business momentum. And let me be clear, a 12% growth rate on a billion-dollar base is strong. It proves that the core demand for their products isn't just stable, it is accelerating at a double-digit pace. So the next question is, where is all this growth actually coming from? Let's break it down. If you look at the US, total non-GAAP sales grew 10% to over $706 million. And internationally, sales grew even faster, 15% to nearly $308 million. But look deeper into the numbers and you see the real engine here. It's supplies. International supplies revenue was up a staggering 22%. This is the classic razor and blades model working perfectly. They sell the pump, that's the razor, and then they generate recurring, high-margin revenue for years from the proprietary supplies. Those are the blades. It is a powerful, sticky business model, and this table right here proves it is working on a global scale. And this is the foundation of that recurring revenue stream we were just talking about. In 2025 alone, Tandem put over 126,000 new pumps into the hands of customers all over the world. That's 86,000 in the US and another 40,000 internationally. Every single one of these pumps represents a future stream of high-margin supply sales. This isn't just about 1 year of revenue. It's about building a massive installed base of users that is going to drive predictable revenue for years and years to come. So from a top-line perspective, the structure that they're building looks incredibly solid. That's a strong case. I have to give you that. $1 billion in sales, record margins, a growing global footprint. It's a really compelling story. But, a house is only as strong as its foundation. And when you drill down past all those shiny top-line numbers and you actually look at the real profitability and the cash flow, you start to see some very serious cracks. The bull case, it's built entirely on revenue. But the bear case, that's built on the cold, hard reality of the bottom line. So let's start putting some real pressure on this structure. And here it is. This is the number that just shatters the whole bull narrative. A full year GAAP net loss of over $204 million. Just let that sink in for a second. After generating $1 billion in sales, after all those operational efficiencies you talked about in the record gross margins, the company was still over $200 million in the red. This is not a small rounding error. It's a staggering, mind-boggling loss, and it immediately forces us to question the entire business model. How can you be this big, this successful on the top line, and still be this unprofitable? This is where it actually gets worse. The problem isn't just the size of the loss. It's the direction it's headed, okay? So in 2024, the net loss was $96 million. In 2025, it ballooned to $204.7 million. The loss more than doubled year over year. This is not a company that is growing towards profitability. Based on this trend, they are accelerating away from it. This is a major, major red flag. It suggests that the costs required to generate that top-line growth are just spiraling out of control. So the structure is getting bigger, sure, but it's also getting a whole lot weaker. So where does the money for all these losses actually come from? Well, it comes directly from the company's balance sheet. Take a look. At the end of 2024, Tandem had a solid $438 million in cash, a pretty good cushion. By the end of 2025, that had dwindled all the way down to $292 million. That is a burn of nearly $146 million in a single year. You have to remember, cash is the lifeblood of any company. It's the steel in the foundation. And when you're burning through it at this rate, you have a finite amount of time before you either have to raise more capital, which likely means diluting shareholders, or make some really drastic cuts. This isn't just a crack. This is a critical stress fracture. Now, hold on. Some bulls out there might argue that the GAAP net loss, it includes a lot of non-cash charges, things like stock-based compensation. Okay, fine. Let's look at adjusted EBITDA then. That's a metric that is specifically designed to show the core operational profitability of a business. But even here, the story is grim. For the full year, adjusted EBITDA was negative $46.1 million. So even after you add back all of those expenses, the fundamental business operations are still losing money. The engine is running, sure, but it is not generating a profit. It's burning fuel way faster than it can convert it to power. And hey, don't just take our word for it. We are not the only ones seeing these warning signs. This quote from Guru Focus brings in a trusted third-party model. Now, the Altman Z-score, for those who don't know, is a formula used to predict the probability of a company going bankrupt. Any score below 1.8 indicates a company is in what's called the distress zone. Tandem's score is negative 0.11. Now, this doesn't mean bankruptcy is coming tomorrow, but it is a powerful quantitative indicator that the company's financial structure is under significant strain. The foundation isn't just cracked, it's showing signs of being fundamentally unstable. Okay, so we have an undeniable conflict here. On one hand, a powerful growth engine. On the other, it's sitting on top of a crumbling financial foundation. The company, they know this. Management isn't blind to the cash burn or the net losses. They see the numbers. So, in 2026, they are launching a massive strategic overhaul. This is their plan to fix the foundation. And the crucial point for us as investors is whether this plan is a brilliant piece of structural engineering or if it's just rearranging the deck chairs as the ship goes down. This single pivot is what the entire investment thesis now rests on.
So what is this big plan? At its core, it's a shift in the US to something they call a pay-as-you-go model. See, historically, they sold their pumps as durable medical equipment, a big one-time purchase every few years. Now, they're moving sales through pharmacy channels. And what this allows for is a model that feels a lot more like a subscription. The goal here is to smooth out revenue, make it way more predictable, and ultimately more profitable over the entire life of a customer. They are literally trying to rebuild the business model from the ground up to favor long-term stability over those short-term sales spikes.
But hold on, here's where the plan immediately runs into trouble, at least on the surface. Just look at their sales guidance for 2026. The high end is $1.085 billion. Now compare that to 2025's $1.015 billion. That's only about 7% growth. After everything you just said about 12% non-GAAP growth, this looks like a major slowdown. Any investor just glancing at this number is going to think the growth story is completely over. But, and this is important, that number doesn't tell the whole story. You really have to understand the heavy lifting that's involved in this kind of transition.
So why does the guidance look so weak on the surface? It's because the transition itself creates massive near-term headwinds. Let's break down the build for you. The company is projecting that the U.S. model change will reduce their reported sales by $70 to $80 million in 2026 alone. Then, another transition to direct operations internationally will cut another $15 million. So think about that. They're starting the year nearly $100 million in the hole from a reporting standpoint. Exactly. This is happening even while they project that U.S. pump shipments, the actual number of units, will still grow by 10 to 11%. So what they're doing is sacrificing short-term reported sales for what they hope is a much more profitable long-term structure.
Okay, so that brings us right to the final verdict. We've seen the incredible strength of the top line, and we've exposed the deep cracks in the bottom line. We've also examined their big plan to overhaul the entire structure. Now, we have to put it all together. Is Tandem an ironclad opportunity that's being forged right now in the fires of a strategic transition? Or is this just a fundamentally flawed structure that is destined to fail? It is time to weigh the evidence.
So really, the crucial point is how you view this transition. As the bull in this argument, I see a strategic rebuild. I see management making the tough but necessary choice to sacrifice those near-term optics for a stronger, more profitable foundation that's based on recurring revenue. And as the bear, I see a high-stakes gamble. This is a company that is already burning cash, it's already losing a ton of money, and now it's adding more complexity and more near-term pain to the mix. The real question is whether they even have the financial strength to survive this kind of painful, multi-year overhaul.
Okay, let's just summarize it all right here on one screen. The bull case. The foundation is that strong revenue growth, right? Topping $1 billion with that non-GAAP growth still chugging along at 12%. And the 2026 outlook, when you actually adjust for all those headwinds, it still shows double-digit growth in pump adoption, which is the key metric for future revenue. And the bear case? Well, the cracks are severe. Profitability is a complete disaster, with a $204 million net loss that more than doubled. The balance sheet is weakening under a significant cash burn. And that 2026 outlook, at least on paper, looks like a dramatic slowdown that could scare away a lot of growth investors. Both sides, you have to admit, have really compelling evidence.
So here it is, the iron financial verdict. Tandem is not House of Cards, but it is a high-risk construction zone. The plan to rebuild the foundation is fundamentally sound, we think, and the path to profitability, with a projected 5 to 6% adjusted EBITDA margin for 2026, is visible. It's there, even if it's a narrow path. Now, for investors with a really long-term horizon and a high tolerance for volatility, this painful transition could actually forge a significant opportunity. But for everyone else, this is a sight that's probably best observed from the sidelines. The question you really have to ask yourself is not just whether you believe in their technology, but whether your own portfolio has the structural integrity to withstand a multi-year rebuild like this.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.